Good morning. This is Professor Marsh again, and this is a special lecture that I've designed for Unit 8A. This is the global comprehensive example of Units 1 through 5. So after I saw the midterm results, I wanted to go back and go to the first 5 chapters and review again the principles and do it in a single lecture in which we can review the entire comprehensive accounting cycle. So I wanted to just come up with an example, and I have, and I've posted it in your materials, and it's just called the Global Comprehensive Example of Units 1 through 5. So to begin with, in Chapter 3, we studied analyzing and journalizing transactions. And I'm asking you to journalize the following 12 transactions for a newly formed corporation called Global Corporation. We're going to record all of its transactions for its first month in business in the General Journal, post these journal entries to the appropriate T accounts, and prepare an unadjusted trial balance. So this is part A of the assignment. And so let's just go through and talk about these transactions. So on day 1, I incorporate Global Corporation, and the shareholder contributes $10,000 in cash for 100 shares of its common stock. So what's happened here? What's happened is that we formed the corporation, and it's received $10,000 in cash. Now, $10,000 in cash in the corporation is considered to be an asset. Okay, what an asset is a debit in accounting parlance. So the normal balance for cash would be a debit balance for $10,000. And then what would the credit entry be to journalize this transaction? Well, assets equal liabilities plus equity. Do we have a liability? No, we have equity. We have common stock. And so the offsetting entry would be a $10,000 credit to an equity account called common stock. So let's go over to the board and just take a look at how to do this. What I'm going to do, and let me move this over just a little bit so you can see it a little better. So there is our board right over here, and we're going to make this entry. So over here, if you can still see me, and we're going to make our first entry. So on day 1, because we always record the day of the transaction, we're going to have a debit column and a credit column. And the transaction was to, the corporation was issuing common stock for $10,000. So we're going to have over here, our entry will be common stock. No, that's not right. Okay, let's try it again. That's going to be our credit entry. When we journalize transactions, we always make the debit entry first. Okay, so we're going to have to make the debit entry to cash. And so our entry is going to be cash, $10,000. And you can put a dollar sign up here, or you could put a dollar sign up above these columns just to indicate that all the entries are in dollars. And then the credit entry, since debits have to equal credits, is to common stock. And then we usually put a description to issue common stock for cash. And that's our description. So that's an entry. That is a journal entry that we would make for the first part of the problem. Now, as we go through the additional journal entries, you're going to see that there are different types. So that was a situation where we had an asset account that was increased by receipt of cash, and the stock account, the equity account, was also increased. So our debits equaled our credits. What about the next one? Okay, number 2. Also on day 1, Global Corporation pays $3,000 in cash for a 6-month lease. So how do we analyze that? Well, let's see. We're not going to debit cash because we're spending cash. So our credit entry is going to be to cash. What is our debit entry going to be? Well, what did we get? We got a 6-month lease. Has any of the lease expired? No, this is day number 1. So this is the beginning of the 6-month period. We got a 6-month lease for $3,000. So what we're going to do is we're going to have a debit to an asset account that represents a prepaid expense. Okay, so we can't recognize the expense yet because we haven't used any of the lease, but we have paid cash for that lease, so we have a place to stay and run our business. And so we're going to put on the books $3,000 as a debit to prepaid rent. So that would be our debit entry. And then our credit entry will be to cash. We spent cash. When you spend cash, it reduces the amount of cash. That's a credit entry. So there's a debit and a credit. And let's do that entry. So over here, also on day 1, we have prepaid rent is the asset that we're setting up. Now we know over the next 6 months we're going to use that rent to pay the lease, but we spent $3,000 on prepaid rent. And then our credit entry, and we usually indent the credit entry. So we have cash over here toward the left-hand margin, and that's the debit entry, and then the credit entry is typically indented. So it looks nice. And this is cash. Okay, we bought a lease for 6 months for $3,000. And this is to record lease. Okay. All right, that's the description doesn't have to be fancy. It just needs to be something to describe what happened. Okay, so that's your second entry. Now you're going to see that we have, I'm doing it on the board, but I also have my fancy accounting worksheets here. And you'll see that what I've done, and you'll find this in your materials when you go through it, you'll see that I have recorded all of the entries for you. So you can see up here at the top, we've got the first entry that we have over on the board, and it looks just like that. You've got a debit to cash, credit to common stock to record the sale of common stock to a shareholder. That might be slightly different than what I said there. Yeah, to issue common stock for cash. Okay, so the entries can be however you decide to describe them. Then we've got prepaid rent for $3,000, and I said, what does it say? To record the lease on this one when I did it earlier, to record prepaid rent on lease. The description doesn't matter so much as long as you've got something on there that records what you did. And then you can see the additional transactions for the third transaction. We paid $120 in cash for a 1-year insurance policy. Well, that's just like the entry for the lease. We're paying for something that we're not going to use in the period, because the period here is only going to be a month. So when we pay $120 as our 1-year insurance policy premium on day 1 of the period, then we record that $120 as an asset as prepaid insurance, just like prepaid rent, and then it'll roll off and expire. It's $120, it's 1 year, so it'll be $10 a month over the next year. But at the end of the month, we'll recognize $10 of that interest expense when we do our adjusting entries. So you set up the prepaid insurance as an asset for $120, and then you show that you paid $120 in cash. That's your credit entry for prepaid insurance. Okay, then on number 4, the fourth transaction, let's see, what did we do here? We purchased a machine for $3,000 that has a 60-month useful life, nice round numbers, and a $0 salvage value. We'll talk about that more when we get to the chapter on depreciation. But Global Corporation pays the vendor of the machine $1,500 in cash and gets $1,500 in credit payable over the next 90 days in equal installments. Okay, I want to put this is a complex entry. This is an entry that has more than just one debit and one credit. So we purchased an asset, $3,000 machine, and we're going to book that as an asset. That's going to be our debit entry. But we didn't just pay cash for it, we paid part cash, and we also got credit from the vendor. So we have to have 2 credit entries to show the purchase of the machine. So how do we do that? So I didn't put it up on the third entry up on the board, but I'll go to the fourth entry here. And how are we going to show the purchase of that machine? So, okay, the total cost, here's also on day 1. I hope you can see this where you're watching from. So day 1, can you see that? Let me adjust the screen a little bit better. Hopefully you can see that. Maybe you can zoom in. We've got, usually when we purchase a machine, we put it in an account called machinery and equipment. That's the typical name for this. So we're going to call this machinery and equipment is our asset, and that also is $3,000. And then down here you've got cash. How much cash did we pay? We paid $1,500. And then we also got credit from the vendor. When you get credit from a vendor, that's called an account payable or accounts payable. So we're going to put the other $1,500 in accounts payable, so that, you know, if we stopped right here, our debits wouldn't equal our credits, right? And so that's not good. So we have to put this $1,500 for accounts payable in there. Now we've got $3,000 in the debit column, and we've got $3,000 in the credit column, and everything balances. Okay, so that's an example of a simple but slightly more complex entry for the purchase of machinery. And as we'll see later in the problem, we're going to have to adjust that account as the machinery and equipment. Machinery and equipment is a fixed asset or a non-current asset that's going to depreciate over time. But it won't all be used up in the same accounting period or within a year, so it can't be a current asset. It lasts for 5 years according to its designated useful life. So 60 months is 5 years, and it's a depreciable asset. Now, the fifth entry. On day 1, Global Corporation borrows $3,000 from the bank, repayable in a single payment of $4,800 in 2 years, which is 24 months. So assume that there's no prepayment penalty and it's straight line simple interest. Okay, just to make the numbers work out. You know, we don't want to have to do compound interest yet or imputed interest, that sort of thing. So we're going to record that. That's a receipt of cash, and then we have a note payable. So I'll just show you how I did it. You can look at the detail in your materials, but this is entry number 5. You'll see that I'm numbering my entries. I'm also putting the day. This is our last entry on day number 1. And so we received $3,000 in cash from the bank. I think you can see that. And we have a note payable, and it's to record the borrowing from the bank. So that's our entry for that. Okay, so a note payable, one that's not due for 2 years, that's a long-term liability. And so we're going to have to record that a little bit differently than we would record an account payable. Okay, it's going to be in a separate account because it's long-term and non-current and not a current liability. Okay, let's go on to the 6th entry. Okay, finally we do something. So now that we've got all the finances set up and we've got all the assets purchased, or at least a lot of the assets purchased, on day 2 we're actually going to do something. We're going to provide some services. And we're going to provide these services and we're going to have $5,000 in revenue. So that's a good thing. So $5,000 in revenue, and the revenue that we receive, $3,000 of it is from customers who pay us, and then $2,000 of it is from customers that we give credit to. So when we give credit to our customers, that's called an account receivable. Okay, so an account receivable from our customers for $2,000, and then cash for $3,000. And I just did the subtraction to come up with how much credit it was. Obviously, if it's $5,000 in service revenue and $3,000 in cash, then the balance is $2,000 that goes into accounts receivable. So this is another complex entry, and you can see it here on number 6. You can see that we have to do the debit entries first, so it's a little bit backwards. Usually the revenue drives the train, but that's a credit entry. Service revenue is a credit entry that'll be an income statement item, and so that's $5,000, but we have to put that underneath the receipt of cash. The debit goes to cash for $3,000, and then a debit to the asset account, the current asset account of accounts receivable, and that's to record our service revenue. Okay. Now the next thing that we do is we purchase some supplies, and as we purchase the supplies from our vendors, we buy $500 worth of them. So that's our debit entry. We're putting another asset on the books for $500, and the way that we're paying for it is we paid cash of $400, and then we got credit from a vendor for $100. So yet again, another somewhat complex entry. You've got 2 credit entries on this, a reduction in cash of $400 for the cash payment, and then $100 for the vendor credit that we received when we purchased some of the supplies. Okay, now what happens next? Well, what happens next is that, remember the service revenue that we had, some of our customers didn't pay us, but now in entry number 8, we've got a customer who owed us $1,000 who pays us. And so we record the cash asset of $1,000, and now we have a credit entry that reduces accounts receivable, and that records a customer who's paying off their account. And this happens on what day is it? It's day number 6. Okay. So those are our first 6 entries, and you'll have a copy of this worksheet, this very fancy worksheet that I prepared with a yellow pad and a straight edge ruler in your materials. Okay, the 7th entry, let's see, 7th entry here is, I'm sorry, no, it's not the 6th entry. We've done 8 entries. The 9th entry is we have a customer who pays $2,000 in cash as a deposit for services to be performed next period by Global Corporation. Okay, so this is part of the difference between cash basis accounting and accrual basis accounting. We're learning GAAP. If we were just, doing cash basis accounting, we'd go ahead and record that $2,000 as revenue. But because we haven't performed the services under GAAP, we can't recognize that revenue. So we have to set this up as a liability to offset the cash receipt. So we received cash That's an asset, and that's $2,000. And then we have deferred revenue. Deferred revenue is a liability account. It's a current liability account. We're going to do the work next period, but we haven't done it yet. And so we have to set that up as a liability. And then when we do the work and we earn the revenue, then we go ahead and we'll credit the revenue and we'll take it out deferred revenue. So that'll be the entry to offset this when we actually do the work. Okay, then the next thing that happens is we pay $500 to the at the end of the month to the vendor of the machine that we purchased in the transaction number 4 back on day number 1. So our first month we owed $1,500 on the credit side of the entry, and now we're paying cash. So we're reducing cash, so that's the credit entry, and then we're paying off an accounts payable, or at least $500 of it. So we're reducing accounts payable by $500. That's your debit entry, and then the credit entry is to cash for the payment that you make. Okay, and then on number 11, the 11th entry that we have, Global Corporation agrees to perform services next period for a customer for $3,000. So how do we journalize that entry? Well, that's the trick question. Okay, the fact is that because of our conservatism and because of our revenue recognition principles, nothing's happened as far as accrual accounting is. We've made an agreement to do work in the future, but we haven't received any cash, we haven't provided any credit, and so we don't have anything to journalize. We haven't provided any services. So number 11, there's no entry that's required. Okay, on entry number 12, on day 31, we pay our shareholder a $500 cash dividend. When we pay dividends, that reduces the equity account. Dividends is a contra account in equity. And then we credit cash for making the payment because it reduces cash. Cash is an asset, and so if you make a credit entry to an asset, it's a reduction in that asset. And we wrote the shareholder a check, and the check is for dividends. So anyhow, so that's the first requirement, is to complete the correct journal entries for the transactions. Now the next thing to do is to post them to T accounts, and as you can see, I have all the T accounts already posted with the numbers of the transactions to which they refer. Now when I do my T accounts, I set up a 5-row worksheet if I can, if I'm doing it by hand. The top row is always the thickest one because it's got the assets, it's got the 100s in our chart of accounts. Remember, assets, liabilities, equity. If you can't remember it, it's ALE. That's something maybe that college students can remember. And then RE, real estate, I don't know, revenues and expenses. You could call REX or something, ALE, REX, maybe, I don't know. That's, anyhow, assets, liabilities, equity, revenues, and expenses. And these are typically the 100 or 1000s accounts in your chart of accounts. Cash is usually 100 or 101. Accounts receivable, and then some of your prepaids and supplies and other things. Then you've got your liability accounts, you got your accounts payable, deferred revenue, and your note payable. You've got equity accounts, you've got common stock, you've got retained earnings, which we're not using yet because this is the unadjusted trial balance and ledgers. So this is chapter 3 stuff, so we don't have really retained earnings yet. And we've got dividends paid, this little guy right there. Here's our service revenue. And as you can see, with our unadjusted accounts, we don't have any expenses yet. We didn't pay any salaries. Maybe it's a startup company and nobody's taking a salary. Maybe the shareholder's the only employee, and all they've done to take money out of the company is pay a small dividend. but we don't have any expenses yet. So we'll get to that when we do our adjustments in Part B. But before we get to Part B, we have to prepare a trial balance. And so when we take all of these T account balances and we post them, and so we have to add up and subtract up, and you can see we've totaled, the cash, and the cash nets out to $12,980. That's probably the most complicated math we have to prepare in this problem. And then you've got your accounts payable, and that nets to $1,100. And there's not much other complicated. I guess there's over here we've got accounts receivable that nets to $1,000, and that's it as far as the math goes in the entries in the T accounts. And then we take those T accounts and we post them over here to our trial balance. So all the asset accounts go first. So as you look at the trial balance, look at this. We've got them all in order. So assets, okay, then liabilities, then equity, and then revenues and expenses. And so since we don't have any expenses, the last entry is for service revenue, and that's our unadjusted trial balance. And look, it balances, which is really great when it balances. If it doesn't balance, remember we have some techniques that we can use to try to make it so it will balance. So go back and find the difference and divide it in half. Maybe divide it by 9. Look for transpositions. Look for debits that should be credits and credits that should be debits. But that's part A of the problem. And it's only taken us 25 minutes to do this. Let's go on to Part B. Let's make our adjusting entries. So we've gotten to the end of the month. We've prepared our unadjusted trial balance. Now we have to do our adjusting entries. Why do we do our adjusting entries? Well, we have to adjust for things that are required under GAAP to accurately reflect income and expenses for the period in which they occur. So the first thing we do is we take a physical count of our supplies inventory, and we find out that we have $250 worth of supplies left out of the $500 that we purchased. So obviously we've used $250 of supplies during the period. And so our first adjusting entry is going to be to book an entry for supply expense. I'm sorry about the light in here. I've got the blinds closed, but it's a very sunny day and it's coming through and creating some glare. So hopefully you can see this, but you'll have this in your materials. And when we do our adjusting entries, just as when we do our regular entries, and I should have pointed this out, we always have a proper heading at the top of our accounting worksheet. So on our trial balance that we just looked at, it was Global Corporation unadjusted trial balance, and then it says for as of day 31, month number 1. And now as we're doing our adjusting entries, we've got Global Corporation adjusting journal entries as of day 31, month 1. And the first one is for supplies expense. So that's an expense, that's our debit entry, and then we credit the asset and reduce supplies by $250 for the supplies we've used during the period. Now what you have to do to make your adjusting entries is you have to go to the various accounts and you have to think about, okay, what other adjusting entries do we have to make? Well, remember that we got a 6-month lease. Well, as of the 31st day of month number 1, we've used 1 month of that lease. So it was a 6-month lease for $3,000. 1/6 of $3,000 is $500. Okay, right? It's pretty simple math. So we're going to book rent expense that we had prepaid of $500. That's our debit entry. We're going to credit the asset of prepaid rent to reduce that asset because we've used a month on the lease. So that's our second journal entry, second adjusting journal entry for rent expense. And just like that is insurance expense. We bought a $120 insurance policy. We've used 1 month of it. It was a 1-year policy, so 1/12 of $120 is $10. So we got $10 in insurance expense, and we're reducing prepaid insurance by $10. You see how this works? That's how it works. Now, what about the machine? The machine, we had those, we had the credit of $1,500. Do we have to do something with the credit that we got for the machine? No, that's different. Remember, we made the payment at the end of the month. Okay, we paid the $500, so we've paid that. That actually came through as a cash expense through our journal. So we don't have to do anything to adjust the financing that we got for the machine. Okay, if we hadn't paid the $500, we would be getting a bill from our vendor, probably with a late charge, saying, hey, here it is. It's been more than 30 days and you didn't pay the $500 you owed us last month. Now you owe us for this month, plus you owe us a late charge for last month. But anyhow, so we've taken care of that. But the other thing about the machine is that machinery and equipment are fixed assets that depreciate. And so even though we haven't really studied depreciation and the various methods you can use to compute it, what we're going to do is we're just going to take that $3,000 and divide it by the 60 months that we say are the useful life. So we've done 1 month out of 60 months for a $3,000 machine. Do the math on that for yourself and you'll see 3,000 divided by 60 is $50. So we got depreciation expense for the first month of $50, and then the credit entry goes to a contra account. Now, a contra account is not anything about fighting Sandinista rebels down in Nicaragua. Okay, a contra account is an account that is one that goes on the asset side, or this contra account for accumulated depreciation is an account that goes on the asset side of the financial statement, but as a negative to the machinery and equipment, to some of the depreciable assets on the books. So we put this in fixed assets and a contra account of $50 for accumulated depreciation. That's the credit entry that shows that the value of our fixed assets are depreciating over time, okay, as we use them. So that's where that goes, and that records the depreciation expense for the period. Now, the next one is kind of complicated, and this is something that's not in your books, but I wanted to point it out. When we did our note payable, we agreed when we borrowed $3,000 from the bank that we would pay them back $4,800 at the end of a 2-year term. We didn't have to make any payments along the way, but every month we have to recognize the interest element in the difference between the $3,000 we received in cash and the amount that we're going to have to pay when we pay off the loan. And I said that it was straight line simple interest, okay, which means that we don't have to worry about compound interest. And there's no prepayment penalty, which is why we booked the loan at $3,000 and not at some larger amount. If we definitely had to pay them $4,800 back whenever we pay them off, that's fine, but we could have paid them at the end of this month and just paid $3,075. So we're going to book interest expense, that's a debit for $75, and then where we put the credit is we add it to the liability of the loan. So we're going to add it to the note payable for $75. If we paid off the note on the first day of month number 2, we would pay them $3,075 and be done with it. So that's how you book accrued interest expense on that sort of a note. Okay, so that's that. Okay, so those are our adjusting journal entries. After we make those adjusting journal entries, we go back to our Ledger T account and post them. So here's our accounts, and what I've done is in red, okay, with little red numbers. I still use pencil because I know I'm going to make mistakes, and you can see I've erased a bunch of stuff here where when I was doing my work I realized I had made a mistake, put something in the wrong account or put in the wrong number or whatever. But you can see that I've got my adjusting journal entries right here. So you can see the first one was for supplies expense. That's number 1 down here, and so I've put the debit entry for supplies expense right there, and then the credit entry is the reduction in supplies inventory. You can see the number 1 up here. That's the first adjusting journal entry up in supplies expense. So that's that word. And you can see number 2 is rent. Here's the rent expense entry up here. And then up here, the prepaid rent is credited to reduce it, and so on and so forth. So we post them in the T account, and you can see all that. And then after we post them in the T account, we have to make sure everything still balances. So we create an adjusted trial balance. And as you can see, it is now longer than the previous one. And the total at the bottom is different than the total on the other one. You're thinking, well, what are you creating, assets, or what are you doing here? You know, the numbers are bigger. Well, these are just hash totals. Okay, these don't have anything to do with the financial position of the company. We present the financial position of the company on the financial statements. This is just a proof that we make to make sure our debits equal our credits in our accounting system. So that's what we do with our adjusted trial balance. And as you can see, it balances to a different number than the unadjusted trial balance, but that's because we booked all these additional expenses and that sort of thing. So anyhow, that's the adjusted trial balance. And as you can see down at the bottom of the worksheet, the math was a little complicated, so I had to combine some things to add it up, but it does add up. So anyhow, you probably have a calculator or can do this on your computer, but if you learn how to do it by hand, you develop the muscle memory for how to do this. Maybe this muscle and then this muscle, okay? And so that helps as far as, you know, remembering next time how to do it correctly. And it also, if you're in a situation that's a little bit unfamiliar, maybe you can remember a technique that you used for something similar, and it'll help you make the correct entry. Let's go on to part C. We're going to close out the books now. So there are 4 entries that we make when we close out the books. Remember? We close out the temporary accounts first. We close out the revenue accounts, which can be revenues, gains, that sort of thing. And we do that through booking an offsetting entry to the revenue account. That's our debit entry. And then we put the credit entry in income summary. And then we do the same thing for the expenses. We remove the temporary expense accounts. All of our period expenses, all of our period revenues, those are temporary. We have to close them out to start the books fresh for next period. So our debit entry is going to be to income summary, and then our credit entries are going to be to all the various expenses to zero them out. Okay, so that's our second closing entry. Now our third closing entry is to take the income summary account, whatever the total is, and it's, you know, it's going to be 5,000 minus 885, or 4,115. We're going to close out the income summary. If income is positive, then you make a debit entry to income summary to zero it out, and then you put it into retained earnings, and that closes out the income summary account. That's our third entry, our third closing entry. And then the last closing entry is just to record the dividends, to close that out too, because dividends just come out of retained earnings. And so we're going to have a debit entry to retained earnings. Why? Because we didn't retain those earnings. We distributed them to shareholders, so they're not retained earnings anymore. So that's the debit entry. Retained earnings is an equity account, so the debit entry reduces it, and then the credit entry is the offset to dividends paid, and that zeroes out that temporary account as well. Those are our closing entries. And look at this. We've updated our T accounts, and I've done the closing entries in black, in a dark black pen, as far as the numbers go. And you can see that I have now, in the equity section, I have created the income summary account that we have. 3 of our entries go through income summary. The revenues come in over here as a credit. The expenses come in as a debit. Since it's a net income, we're going to have another debit to zero it out, and then that goes into retained earnings. And then the dividends account, you can see that the dividends were paid, so we're going to reduce retained earnings by 500, and our net retained earnings are going to be 3615 at the end of the period, and that are our closing entries. So that's that. And then, just to make sure everything still balances, now we have this nice short post-closing trial balance. And as you can see, yet again, there's a different hash number down at the bottom here. But these are just our balance sheet accounts. These are the permanent accounts that stay on the books to open up the next period. Okay, and so you can see, again, we've done it with the assets first, the liabilities, and then the equity accounts, and so on. But we just don't have revenues and expenses because they're temporary accounts. And we've gotten rid of the dividend accounts. Okay, now we prepare our financial statements, and the first one that we prepare is our income statement. And we take the income statement numbers off of the adjusted trial balance. And so as you can see, this is a sloppy but I think technically correct income statement. It's labeled income statement, Global Corporation income statement, and it's always for a period. So this is for the month one. So for month number one, we have revenues. We got 5,000 in revenues. We've got all these expenses that we accrued, and we've got our net income. Okay, and you can see the format. This is a this is a properly prepared income statement. Okay, so revenues minus expenses equals net income, and that's the income statement. Then we've got our balance sheet, and now the balance sheet, we take this from the post-closing trial balance. So this is just a classified balance sheet. It's got current and long-term or non-current assets and liabilities. Those are all properly listed. We've got subtotals at all the appropriate places, and as you can see down at the bottom, thank goodness, total assets equal total liabilities and shareholders' equity. Okay, so that's our basic accounting equation, and that's how you present it in the balance sheet. Now this is something, I don't know that the book did that great a job in showing you the statement of changes in shareholders' equity. So I prepared one myself for this problem. What they did is they kept giving you statements of retained earnings. I think that that's maybe a small weakness in the book. But anyhow, we began the period, since it's our first period, our balance in owner's equity, shareholders' equity is 0 on day one, and then we increase it by our income for the period, and then we reduce it for the dividends that were paid, and then we also increase it by the common stock that was issued, and this is our balance as of the end of the period. And we take this information from the adjusted trial balance and also the income statement, so to get these numbers. And I think that's it. So I think that was the problem. It's only 43 minutes. I could probably do it a little faster than that, but I think when you watch this video and try to copy what I've done, you probably have to pause it from time to time, but that's okay. Practice it until you get it perfect. Again, it's like, I know I've said this several times, but it's like, in baseball, you have batting practice. In basketball, you do layup drills and you do free throw drills. It's the same sort of thing. You do it enough times that you have the memory of doing it correctly. If you go out this weekend or stay home and watch the Final Four, you'll see, 4 of the top teams in the country, and several of them, particularly Villanova, when they shoot free throws, I mean, it's almost automatic. That's not just because they're particularly talented. I mean, that's hard work. If you go back and look at some of the great players in history, I can think of Karl Malone, the mailman, who played, when he was in college, he was a 50% free throw shooter. He was no better than Wilt Chamberlain or Shaquille O'Neal. But when he got into the NBA, one thing that he realized very quickly is that he was able to draw fouls better than almost any other player. He shot more free throws than most other players do, and maybe some other teams did. And so he worked on perfecting his free throw shooting and became almost an 80% shooter by the time that he was finished with his career. In fact, really over just the first couple of years, he improved his percentage free throw shooting from the 50s up to the 70s or even the low 80s for some of the years. So anyhow, that's something that you can practice and learn. And with that, I'm going to say goodbye for now. But please take this assignment very seriously. It's a very important way for those of you who maybe didn't get it the first 5 units that we did to get it. And I hope that you'll find this useful as this semester goes along. So I'm going to sign off right now, and feel free to contact me if you have any questions or comments. Thanks a lot. Have a great day. Bye-bye.